In this podcast, we have a special guest today. He retired at the age of 46, is earning six figures in dividend income, and has built up a net worth of over $6 million. Hi, I'm Kanwal Sarai, and welcome to the Simply Investing Dividend Podcast. Our guest today, Ales Eisner, lives in Edmonton, Canada, and is a disciplined, self-taught investor. We talk about how to get started in investing, how to invest in the current trade war around tariffs, and how he built his portfolio. Ales, welcome to the Simply Investing Dividend Podcast.
Thank you very much.
We're very happy to have you on our show today. We're hoping we're going to get a great discussion talking about investing, talking about dividends, of course. That's the biggest topic for our audience. I'm going to get straight to it. Your website, looked at it, it's great. You've got a lot of information there. It says that your net worth is a little over $6 million. Can you share with our audience how you got to that point?
Yes, I'm about 6.2 million, and what I did was I worked in IT and did not particularly enjoy the work, and just one day I really made it a goal to become financially independent and retire early. And that's what I did. I saved and I invested. I started in my 20s with a financial advisor, and then over time I taught myself more about individual stocks and mutual funds and all of that. And I really was focused on putting away as much as I could and investing. And in the end, it paid off. I retired when I was 46 from working in IT, and at that point I was at 3.3. I told my manager. And as a result, I was able to keep growing the portfolio without working, and now I'm at over six. But then again, there was a nice run from basically 2008 to 2022, arguably. So I did have some luck in getting to where I wanted to go.
Yeah, that's a great, fantastic story. And I don't know if you want to share with the audience as well. It's up to you. Like I mentioned, dividends are key for our audience. And we were talking briefly off camera about your annual dividend income. So where is that today?
So, for the benefit of my accountant and for me, I added up all the different sources of dividends because I have three different brokerages and so on. And most of my investments are in non-registered accounts. And it all added up to, for last year, for 2024, it all added up to $159,000. Uh, Frankly, that's more than I expected, arguably maybe more than I wanted, because the taxes start going up as you go up in the tax brackets. But yeah, anything over 120, then capital gains become more tax efficient. But up until then, Canadian eligible dividends, which is what I'm going for in my non-registered accounts, is taxed very little. So I'm still averaging about 10% average tax rate, which isn't bad for the amount of income that I have.
Yeah, that is fantastic. Now, you mentioned non-registered accounts. What would you recommend for somebody, young Canadians who just started working, been working for maybe 5, 6 years, are looking to invest? Conventional wisdom, everybody says just put all your money in RRSPs. But what would you recommend between RRSP, TFSA, or non-registered for someone just starting to invest and looking to grow their dividend income?
Well, again, being fairly tax conscious, RRSPs don't help you as much until you get into the higher tax brackets. So if you're just starting out, usually TFSA should be the first thing that you should max out because you're in a low tax bracket and you don't get a good bang for your buck in RRSPs. But for the TFSA, you don't have to pay much in taxes to get that after-tax dollar for the TFSA. So I would max out the TFSA first, and then once you get over $50,000-$60,000 a year, or if you think you're approaching your peak income for you, whatever it's going to be. Some people max out at 200,000, some people max out at 70. That's when you should start taking advantage of RRSPs more. Alternately, you can put money into RRSPs early on, but not take the deduction and save it for when you're in a higher tax bracket. So that's the other way to go. Or, of course, the FHSA that we have newly coming out if you're eligible for it. Best of both worlds if you are going to use it to buy a home eventually.
Okay, yeah, no, that's a good advice for the American listeners. Something similar would be like a 401k, where you can grow your capital gains and dividends tax free until you take it out. So it's kind of deferring the taxes for later. But something to consider for our U.S. audience as well. Now, I know you're passionate about teaching young folks to get started investing early. Why is it so important for folks to start investing sooner than later?
Well, I think the fact that I started early and started learning early was what got me to where I am. So I started in my early 20s. I think it was the second job out of university where a financial advisor came into the office trying to drum up business. And I'm like, well, I've got some money. Actually, I was lucky enough that through my education, I had a scholarship, and I was able to live at home. So I didn't have any debt by the time I graduated. So I actually had money, and so I started investing with him. It was in mutual funds. It didn't do very much, but it really made me start learning on my own so I could do better.
Mm-hmm. Now, what about individuals that are that haven't saved up or invested a whole lot of money, and they're now in their 40s and 50s, right? Is it too late for them, or is this something that they could get started right away as well?
The cliche is the best time to start investing was yesterday. The next best time is today. Obviously, for the young folks, you get the compounding running early, and obviously that's an advantage. But anything is better than nothing. So if you're in your 50s and you're like, okay, I want to retire, I don't have anything saved, I've just paid off my whatever it is, start. Because you might not make it to 5 million by the time you retire, but having 300,000 is better than having nothing. It will improve the quality of your life, and maybe between various pensions and CPP and OAS, you'll still end up having a decent retirement, even though you didn't start when you were 20.
Yeah, that's great advice, and I love that what you just mentioned, right? The best time to start investing was yesterday. The second best time is today. So I think that's really good advice for folks to get started. Now, you mentioned in the beginning too, the majority of the dividends were coming from Canadian dividend stocks, right? That's where it's coming from. Can you share with the audience what are some of the things that you look for? Because I think a lot of people get overwhelmed when they look at the TSX. There's thousands and thousands of stocks there. There's a lot of dividend stocks. There's a lot of non-dividend stocks. How do you decide? What is your process for selecting which companies to invest in?
Well, so I do see myself as a value investor and as a dividend investor. Value means it's either cheap or pays dividends. So I always look at the price to earnings ratio. And for me, I sort of live in the 10 to 20 for a price to earnings. So basically, I'm paying $20 for a dollar of the company's profits if the PE is 20. That's sort of where I draw my limit. Obviously, it's a combination of many different things. So if something is a PE of 23, I'm not going to avoid it. But I try to avoid something that's in the 50, 60, or triple digits. So, for example, Canadian growth company Shopify, that's something that I could never get into just because it was always trading on future expectations and sentiment. So I look for things that are reasonable. So that will be Canadian financials, oil companies, and so on. They pay their dividends, their profits cover the dividends, or at least I make sure that the cash flow that they have covers the dividends. You can look at operating cash flow as well. There's various metrics depending on the sector that the company is in. But generally, I want to make sure that the dividend is sustainable. I'm not looking for something that's paying out 8-10% dividend yield because that seems a little bit unsustainable. But I also want to make sure the company isn't overpriced and that there's going to be some share appreciation as well.
Yeah, absolutely. And I think you touched on it a little bit when the dividend yield is so high. There's companies out there today where the yield is like 14, 18%. People refer to those as dividend traps. Um, I think I know what the answer is, but I'm going to ask you anyway. Why should somebody avoid a company that has a dividend yield of 18%?
Well, so for beginners, they think, "Oh, this company's doing great.
That's right.
Look how much they're paying. That's amazing." And the thing is, the dividend yield is the dividends that it's paying divided by the share price. And as a fraction, the reason why you get 18% dividend yield is because the share price has gone down. And so the company's actually in trouble, and it's quite likely that the dividends are going to get cut. So you try to avoid that. Now, there is the strategy of the dogs of the Dow. You can do the dogs of the TSX as well, where you pick 10, 20 on January 1st, 10, 20 of the highest yielding
Yielding. Yeah.
companies. You buy those. You're going to be collecting double digit cash flow return, and if the companies recover, great. You do really well because it's likely that their share price is super low. And then you sell them all off December 31st, and you do that again. That is actually a viable strategy, not for the faint of heart. It does seem to outperform the regular index, but it's not something I would try.
Yeah.
My portfolio, I'm fortunate enough that it's sizable enough that if I get 3, 4, 5% yield, I can live comfortably off of it. I do track my spending religiously, and I spend about $40,000 a year, and of course that's a fraction of the of what I have coming in. So I'm quite lucky that way.
Yeah, no, that's great. And I think it's great advice as well is to track your expenses, right? And I think that's what gets a lot of people in trouble is spending more than they have, than they're making, right? And that gets you in trouble. But I want to get back to the other comment just quickly about the dividends. We talked about dividend traps. The other thing that I hear often, especially when people hear that, I'm a dividend investor, I've been doing this for over 25 years, the biggest comment I get back is, well, dividends are not guaranteed. Companies can cut the dividend. Look what happened during COVID in March of 2020. Boeing cut the dividend to zero. Disney cut the dividend to zero. Same with General Motors. So what do you say to people like that when they say, well, it's not worth investing in dividend stocks because the dividend isn't guaranteed?
It's true. I think it's a bit of a culture thing because I've noticed companies outside of North America, if they make a profit, they pay a dividend. If they don't make a profit, they don't pay a dividend. While what people expect from US and Canadian companies is that they're going to keep paying the dividend and ideally to grow it. And companies will go out of their way. Some of them will even borrow in order to keep paying the dividends. So they will definitely try their hardest to keep paying the dividends. And like Canadian banks, favorites for a lot of Canadians, they've been paying their dividends for a century, literally for 100 years. They haven't cut their dividends. So, yeah, they're not going to double for you in the next 2 months as far as share price, but they are going to keep paying that dividend. And as the share price increases, the return on your initial investment can also be quite eye-opening. So that's what I look for, and I buy companies that are going to keep paying that dividend. I don't buy kind of fly by night, flash in the pan kind of companies. That's not my
Hmm.
style.
Now, do you look at the dividend history at all for any of the companies before you invest in them?
Definitely, I look for the ones that are growing the dividend at a regular pace. 6 to 10% seems to be kind of the going rate that the
Mm.
dividend is increasing every year. So if it's paying 4% now, I'm expecting it to pay 4.4% next year and then 4.9% the year after that. On the initial investment, right? Because that's locked in. As long as the dividend keeps increasing, the price that I paid for that money to come in, that's locked in because that's what I purchased it for. So
Mhm.
definitely, I look at the history at least 5 years if I can, and uh, I'm a little wary of something that increases its dividend 30%. What happened? Was that a one-time payout, or uh, did you pay 1% dividend yield prior to that, and a new CEO said, "Hey, we should really ramp up the dividend." Now suddenly they're starting to increase it very quickly. Those increases should be sustainable as well, or they should be communicated as one-time increases.
Mhm. Yeah, no, that's good. I think the looking at the history for me, it's so important because it gives me some level of confidence that a company that has a strong track record of paying dividends and growing the dividend, that it's hopefully going to continue doing that for many more years to come, versus a company that has, they paid the dividend once in 5 years and then they stopped. Now they're paying it again. I don't know if they're still going to be continuing to pay dividends for the next 2 to 3 years, right? Um, the other question we get a lot from our audience too is thinking about how many stocks should I hold in my portfolio? So, do you have a number that you work towards, or?
I would preface this question as do as I say, not as I do. The approach I've taken in my portfolio is for tax efficiency, I do Canadian dividend payers because in my non registered accounts, I'm looking for Canadian eligible dividends. So individual stocks is ones that pay dividends, and I have about 45 Canadian stocks that are dividend payers. And then I have another 20 or so American stocks or Chinese stocks through ADRs on American stock exchanges. And for tax efficiency, I'm looking there for capital gains rather than dividends. If they do pay dividends, great, but I'm looking for good companies that are going to grow and I'm going to sell them for a profit, and then it's going to be taxed as capital gains. Anything further afield, I do through exchange traded funds or mutual funds. I'm a big believer in emerging markets because of demographics, that's where the growth is going to be. Young population, growing population, being pulled out of poverty and wanting to spend and become middle class, as opposed to developed nations where there's no population growth and it's tough for companies to make more money in at least the way I look at it, without population growth. And Canada and US wouldn't be increasing in population if it wasn't for immigration. So what I'm doing is I have about 60 individual stocks and then another 20 mutual funds and ETFs. That is more than I would recommend to anybody because it's almost a full-time job to keep on top of everything. And from the research that I've read, you're pretty much approaching, well, just holding an index at that point. Once you get past about 20, you're pretty much just holding the index. Mine obviously is geared towards dividend payers, so I have better control by having individual stocks and having that many. But if you enjoy stock research and the analysis, then you should have 10 to 20 well-researched stocks. If you're a beginner or somebody who does not enjoy stock analysis, and I would argue most people probably don't, then just have 3, 4 ETFs. I do one for TSX, one for S&P 500, one for developed nations, and then fourth one for emerging markets. I would cover the whole world that way, and it's very simple, and you really don't have to do very much. So that's sort of the easy way of doing it. So
Yeah.
to get back to your question, I do have a lot of stocks. I would have more than I would recommend.
Mhm.
So start out with ETFs. If you enjoy the stock analysis, then do 80% of your portfolio in ETFs, and then with 20% of your portfolio, do the 10 to 20 well researched, well kept on top of stocks.
Hmm. Okay. Yeah. And in terms of with the ETFs and the mutual funds, do you have any recommendations for the audience in terms of the fees, the MER, right? The management expense ratio can sometimes get high with mutual funds. Um, does that come into your research or consideration before you invest in those?
It absolutely does. So the mutual funds that I use are either Series F, meaning they have low MERS, management expense ratios, because they don't pay any commissions, because there's no financial advisor, or there's do-it-yourselfers, which also don't pay any commissions to financial advisors. So through my discount brokerages, I can buy the mutual funds. Uh, I know mutual funds get a bad rap because a lot of them underperform the index. A lot of it is because of the high fees, because the index doesn't have any fees, and then the mutual fund, they want to keep the lights on. And then if the mutual fund was sold through a financial advisor, the financial advisor will get between 0.5% to 1% annually for
Mm.
ongoing financial advice. Uh, and so the mutual fund is already 2.5% behind the index right away. So then it's tough to
Yeah.
outperform the index. But if the fees are low, and you get good stock picking, my mutual funds outperform their index over a 10-year or 15-year period. So that's what I look
Mm.
for. And for European stocks, Asian stocks, like I really have no easy way of doing the research. And so I'm happy to pay somebody 1% a year in order to do the research for me. So my mutual funds are actively managed, and then ETFs, I seem to go towards the index followers, so they're passive.
Mhm. Okay, yeah. And so back to the individual stocks, and you've got quite a few. Um, what are some of the things that you consider before you sell any of the stocks? Or are you a buy and hold investor? So how do you?
I'm a total buy and hold. I'm the Warren Buffett type. I In order to minimize my effort, once I've bought the stock, I try not to sell. So I want to buy a stock in the first place that I'm going to hold forever.
Hmm.
So Canadian banks are big ones. I mean, in Canada, we basically have financials, materials, and energy, right? We don't have that much to choose from. So I look for stuff that I'm never going to have to sell. If I think something has come up and now it's sort of going to be bouncing at the top, then I might sell some of my position. And on the flip side, if something has gone down and I've lost faith in the stock and I don't think the story is true anymore, whatever the reason was that I bought it for, that's not true anymore. Then I'll bite the bullet. I'll sell it for a capital loss, and I'll put the money where it's going to do better for me. So those are kind of the two reasons why I would sell. Is one, I think this is just a bad stock. Something has changed. It's not doing what I want it to do, and I want to allocate my money to where I think it's going to do better. Or if the stock has gone up and I'm thinking it's going to be overpriced now,
Hmm.
then I would sell either part of the position or all of the position. As an example, I bought Nvidia some time ago, and then not quite a year ago, I was up 400%,
Hmm.
and the PE went into the high 40s and the 50s, and I'm just like, okay, it's a good company, but it's too expensive for me. It got bid up too much.
Hmm.
So I sold it and I used the money to buy something that was kind of near the bottom as a value investor. Obviously, timing is important. Nvidia kept going up, but again, a cliche. Nobody ever lost money taking a profit. So that's sort of my approach. Um,
Yeah, absolutely. Like it's impossible to predict, right? With even Nvidia, nobody knows or knew how high it was going to keep going. So I think your approach makes sense. Is when you look at the PE and it looked like it's overpriced now, then just take the profit. Would you end up? Would you eventually buy back the same stock if the price dropped eventually over time?
I I'm trying to remember if I ever have. I would be open to it, just like any stock, right? You're always evaluating, is this a good buy, and if the price drops, I'm still thinking this is a good company. Then I would certainly buy it back. Sure.
Hmm. Okay. Now, just for our audience, as of this recording, it is the first week of February 2025, and the biggest headlines in the news right now is tariffs, right? So the US a couple of days ago had announced 25% tariff on all Canadian goods. Canada said the same thing, 25% on all US goods. Has that changed your approach to investing? Given all the stuff that's been happening in the news?
No, not at all. Uh, we'll see how well the video ages, because it is quite a dynamic situation. Tariffs hurt the company, sorry, the country that puts them on. So I think it was actually a bad idea for Canada to retaliate, because
Mm.
that is going to hurt us. And if the tariffs actually end up staying on for a significant period of time, uh, it could put us into a recession. So I'm hoping that the US and Trump are just using the tariffs as leverage to get whatever negotiating power they want. The whole fentanyl and border thing, I'm it's such a tiny percentage of the drugs that are coming into the US through our border. I have no idea why that's being brought up, but it is being brought up, so we need to address it, and hopefully the tariffs will go away. Uh, It did not change my approach at all. First of all, because it does not have to happen at all. And these sort of things happen all the time. The media is always looking to get clicks and views, and if there's nothing terrible going on, they're going to invent something in order to scare investors and get the clicks, because fear sells. And I'm not going to liquidate my portfolio, pay all the capital gains taxes from all the increases all at once in the same year on a hunch, and then sit in cash, waiting and hoping that the market drops. Uh, I want to stay invested, and whenever I get money available, I never sit on cash. I always invest it, because you could watch the market grinding upwards while you're sitting on cash, getting a couple percentage points, and you're missing out. My approach to these things is, if the market drops 20%, becomes a bear market, I will borrow to invest. But otherwise, because of all the dividend income, I don't really have much of an emergency fund, and I certainly don't have an opportunity fund where I'm sitting on cash. And I certainly wouldn't want to sell out and have 5-6 million in cash sitting somewhere, waiting, hoping for a correction, just because Trump or any politician said something that made me afraid. Like, I've been through all of this before. I've been through the .com. I've been through the Great Recession. Things don't really scare me anymore.
That's right. I think it's important not to have a knee-jerk reaction. And I think you and I are old enough to remember the .com, 9/11, the 2008-2009 financial crisis, COVID, and each of those periods, the headlines were like, "This is it. It's over. We're headed into a recession." Some of them said we were headed into a depression. And I think if you are, like you said, if you're quickly influenced or you get afraid with what you're reading on the news and you sell everything, I don't think that's the right approach, right? And just doing it based on like you said, like on a hunch, or I think this is what's going to happen. It's impossible to predict what the future is going to look like.
Yeah, I'm quite active on TikTok and on YouTube, and I get comments all the time. Is like, we're going into a recession, we're going into a bear market. What do you base that on? Well, this and this and this. But we have these sorts of fears all the time, and the market might drop. There might be a 10% correction, and then it just keeps going. So for me, there's a small percentage maybe of laziness, that I just don't want to go through all those transactions of selling those 60 stocks and all of
Mm-hmm.
that. Like, it just seems like a lot of work, and then it may not happen. Like, what you're afraid of won't happen. But what I do know is that in 5 years, and almost definitely in 10 years, the market is going to be higher. So,
Mm.
like, why try to gamble that this is going to happen? Yeah, so I don't. I just don't. Obviously, watching your portfolio, I try to look at my portfolio in percentages. I don't try to look at it in absolute dollars, because with the size of the portfolio, it ends up being painful. Like,
Mm.
I'll lose $30,000 in one day. Just so, but like, I know people who lock themselves out of their trading accounts when there's bad news. Like, I look at
Mm.
it all the time, but I don't do anything about it. Right? Just like some self
Yeah.
control. Like, I'm an adult.
Yeah, I think the key is it's not to panic. And I think if you're gonna, that's the worst time to sell, is when prices are down, everything's tanked, and that's the worst time to sell. I would say that could be a good buying opportunity sometimes.
Oh, absolutely, absolutely. The thing with me being fully invested at all times is that I don't have cash. And whenever I do get some cash, I know it's not going to sit idle. Like, eventually there'll be some opportunity, and it's going to get invested.
Mm.
And COVID I mean, obviously a tragedy, but as far as investing, it was amazing for my portfolio. 2020, when it started dropping, I borrowed. I maxed out the HELOC and I borrowed because I knew that either we were going to live in some Mad Max dystopian society where everything was just going to go badly and nobody would care that I maxed out my HELOC, or technology would prevail and we would get a vaccine and everything would come back to normal. And obviously, the latter happened and everything recovered, and I made out like a bandit. So, I think over time, our society will win out and things will kind of stay normal and the market will grind upwards. And you'll get the odd drop, and it's not pleasant. It's not fun. Like during COVID, like I lost quite a bit of money on paper, but never sold anything.
Yeah. And if you look at the stock market returns, I mean, you can look at a 100-year graph or a chart, right? And you'll see, in in small sort of uh, years, you'll see it go up and down, up and down, up and down. But overall, it does this,
Mm-hmm.
right? And I think that should give people some confidence about the long term, taking a long term perspective on where the market is going. So, what advice would you have for somebody today who's in their, I don't know, 40s? So they're, and they've got a job, they've got kids, they've got a mortgage. They're sitting on the sidelines because they're worried about everything we just talked about, the tariffs and everything else, inflation. What advice would you give to somebody like that when it comes to investing for their future?
I would say start now. Uh, do a little bit of reading, educate yourself. You don't have to become an expert. And just start, as I said earlier, with exchange traded funds, low fee, passively managed, just following an index. There's so many places on the internet where you can get sample Canadian portfolios. Um, it would have been better if you started 20 years ago, but you're in your 40s. Uh, Depending on what your mortgage rate is, make a decision whether you want to pay that off first, or whether you're going to invest. Obviously, 7, 8, 9% is sort of the long run average for the stock market. So as long as your mortgage isn't over that in interest, you're likely to be able to beat that investing. But obviously, it's risky while paying off the mortgage is the safer thing, right? Like if your mortgage interest is 6%, while you could get 7, 8, or 9 as an average, but it could be 20% one year and it could be -10 the next year. Then you sort of have to look within yourself and say, okay, how am I feeling about this? Like I'm quite risk friendly. I mentioned that I don't mind borrowing to invest, which essentially by not paying off your mortgage, you are sort of indirectly borrowing to invest. If you're not comfortable with that, then pay off your mortgage. Your real estate isn't going to beat the stock market over the long run, but it's a place where you live and it's going to make you maybe feel a little bit safer. Um,
Peace of mind, I guess. You can sleep better at night.
Peace of mind. I invested in real estate in the U.S. in the past. I started buying in 2009, and then I bought four total. They all tripled in value, but they were not the lifestyle that I wanted to live as far as having to, and it was all through property management. I actually never saw the properties. I'm also not a good flyer. So I bought them sight unseen and professionally managed. I bought them for, I'm going off on a tangent. I hope this is interesting. I bought them for cash because at that time they wouldn't lend to foreigners, but they were super cheap. They were super cheap. But just constantly having to worry about what's happening at the property. Did the air conditioning break? Is somebody going to sue me? Because the U.S. is quite litigious. Uh, and because there was no leverage, I was getting 2-3% in cash flow, plus of course the appreciation. So I sold them one per year as well, and
Mm.
real estate isn't my idea of peace of mind, because as I took advantage, they definitely dropped, because those houses were 3 times the value at their peak, and I bought
Mm.
them for a third of that value, and then they, over the next decade, they tripled again. So um, if somebody stuck with their house, their money went for a ride
Mm.
during that decade. Uh,
That's right.
so I'm okay with the volatility of stocks.
Mm.
But of course, that's me. If you're talking about a generic family, maybe who isn't that interested in it and maybe hasn't educated themselves, then I can see how people don't like the volatility. Um,
Mm.
but I would. It's all on your life goals. What do you want from your money? What do you want if you're in your 40s? When do you want to retire? Do you want to save for a trip? Do you want to own a boat? Like it all depends. So what are you using the money for, and when do you need the money back?
Mm.
And uh, for me, at the end of my IT career, I was investing 85% of my income, and I was living on 15%. That's obviously
Mm.
quite extreme. Most families are not able to or don't want to do that. But
Mm.
if you really want to retire early, then try for 50% of your income getting invested. If you just want to retire at 60 or 65, you don't have to do anything so drastic. But run the numbers, get a financial plan, and then figure out, okay, how much austerity are we willing to put up with here? Talk to your spouse, talk to the kids. It's like, we're not going to Disneyland anymore. We're saving for retirement. So have a plan. 15% might be what you're willing to do, and if you got 20 years, that might get you into a position to retire at 65 plus CPP plus old age security, and so on. So that would be what I would look at if I was 40 with a mortgage and wanting to do something. But for me,
Yeah.
I was well motivated because I wasn't enjoying my career, so I was well motivated
Mm.
to to save a lot and invest a lot.
Yeah, it sounded like you were looking for early retirement, which you have accomplished. I've seen that on your website, right? Can you tell our audience at what age did you retire?
Yeah, I was 46 back in 2020. Prior to,
Mhm.
prior to COVID, there was an IT project which I knew was going to be a just a terrible experience for people working in it. I also
Mm.
discovered that at work, much like in the army, the people giving the orders aren't the ones carrying them out. And I'm like, yeah, the people who decided this project was going to go live at a certain point were not the ones who were going to work 12-hour days.
Mm.
And I'm just like, yeah, I just don't want to do this anymore. Up until then, I didn't. You never know how much is enough.
Mm.
That's the thing. You can do all the planning, the 4% rule, all of that, and it's like, what if the market drops?
Mm.
Little did I know that just a few months later it was going to.
Mm.
But I basically had to be pushed into quitting, because otherwise I would have just kept working because I didn't know how much was enough.
Mm.
So I started running a YouTube channel and later a TikTok channel, just to kind of keep in practice or what have you.
Mhm.
But I didn't change careers. Like I didn't start doing something else.
Yeah, no, that is a great success story. That's incredible to be able to retire at the age of 46 I think most people will be happy to make it to 65. And even then, in Canada, we see people who are not retiring until they're 70, right? Because they haven't saved up enough or haven't invested enough. So I think that's great. And the advice that you gave before, with the example of somebody in their 40s, I think it's fantastic, which is just you need to get started. Just get started. And even with good health, you're looking at another 35, 40 years or more, right? So it's still not too late for someone at that point in their life to start investing. So, Alesh, thank you so much for all your information and sharing your story with us. I really appreciate it. Where can people find you online if they want to get in touch with you, ask you a question? Where can they find you?
Sure. So my website is canadianmoneytalk.ca, and I'm also YouTube channel, Facebook, TikTok. It's all Canadian Money Talk, and I have a Gmail account. People can just email me and we can chat. It's CanadianMoneyTalk at gmail.com. So, get in touch. Well, if you have questions, I'm happy to help.
Okay, that sounds good. We'll put the website link in the description below in our video. So, Alesh, thank you again so much for your time. I really appreciate it. Really enjoyed having you on the show today.
I enjoyed chatting with you.